There are two sectors that are really important to staying retired and retiring strong. One sector is telling us when people are worried, specifically when retired people are worried. The other sector tells us when they're not worried. In fact, they're like, hey, things are good. Good things are coming. Now, here's the thing. Knowing which one is outperforming the other is important because it cuts to just right to the bone of telling us whether we should or should not be worried. And if you're not retired, it actually doesn't matter because people who are retired, they control all the money, pretty much the majority of the money in the stock market. So what they're doing and how they're behaving is important. Stick around, we'll get to that. Hey everybody, RC Peck here. And this week, I want to talk about where money is flowing for people who are retired. Let's just use the number 65 years old. If you're over 65, collectively, all people over the age of 65, they kind of control where the stock market goes, right? If they're selling out of a sector because they're worried about the future, that's going to really put a lot of negative impact into that sector. But if they're moving their money into, another sector, it's going to really tell us a lot. So I want to talk about this week. I want to look at two symbols this week, and that's it. Really simple, probably just look at three charts and then wrap this up. So give me a moment. I'm going to pop over to looking at the price charts. Okay, the first price chart I want to look at, remember, we're only going to look at two symbols today. We'll look at three price charts. But the first price chart and the first symbol I want to look at is technology. Now, technology isn't really technology anymore. Tesla's not in here, Amazon's not in here, Google's not in here, Meta's not in here. I consider all those technology companies. I know other people don't, but let's just look at technology itself. Now, it stopped going up at the end of 2022. And I kind of sound like a broken record because I feel like I've been talking about this old lifetime high back, you call it January 1st or end of December of 2021. And XLK technology is right up there. You can actually probably put that line there. So it's flirting with new lifetime highs. Now this matters for retired people because this tells us the strength of the market. Technology usually, not always, usually leads the market higher and usually leads the market lower. So if money's flowing into technology, even if you don't want to buy it, it's telling us about the strength of the market. And right now it's telling us it's strong and it's also at an inflection point. It's either going to move higher or move lower. Markets don't really go sideways for that long. Now, if you look back to the end of 2021, markets kind of just went sideways they were making new highs. The new lows weren't getting low, or the lows weren't getting low, but basically for 2 months, and I'm looking right here, right? The market moved higher, but not decisively. And so we're back to that point 18 months later. And so the market, what I was wanting to point out was that it just doesn't really go sideways for that long. So we're either going to break up and out, or we're going to have a pullback, and the market's going to look for, hopefully, if you want the market to go higher, more buyers. Now, at the opposite end of this is utilities. This is historically a place people put their money when they're worried. Utilities are not going out of business. Historically, they yield more than technology does. And you can see during the same time where technology, this is the end of 2021, beginning of 2022, technology had a little bit of a peak, but it didn't top there. It actually kept going up until September of last year. Now, if you remember from some of my other videos, October was the period where almost all equities bottomed. I say almost because January 1st of this year was another time where equities. But right here is where most equities around the world stopped going up and utilities continued going higher. But really, if you just look, it's just kind of a big mess. If you look at what XLU or utilities doing. The reason I put my line down here is because that's the pre-COVID high right there. And that's where buying has come in, right? So that's kind of the bottom. And then you have this double or triple or quadruple top up here. And utilities are nowhere near it. They're just kind of lost in the middle in this sideways maze, kind of listless, rudderless. Okay, so nothing on that is telling us anything. But if we take technology and we divide it by utilities, so let me just tell you what we're looking at is if the black line is going higher, That's telling us the stock market's healthy. And let's just go with that. The stock market's healthy. Now, the first thing I noticed when I looked at this is there was a double bottom here. I'm looking here. There was a bottom here in October. I guess it was September, actually. A bottom here in September, and then a second bottom here at the end of December, beginning of January. So if this black line is going higher, that means people who are retired and have their money in the stock market, they are not worrying, right? The market's moving higher, they're doing fine. Here's the thing, we're kind of back to that, right? Just like before, we are back to that old 18-month high. And so if we start to see this line fall, especially with speed, and can't retest or can't break out, that's telling us people who are retired or people that are going to retire, they're taking money, either they're taking money out of technology and saying, yeah, I'm going to take some wins here, or they're moving money into utilities, or both. And so that's really what we're looking at. Again, what was interesting was this double bottom, right? Because a lot of stocks bottomed here, and the ones that didn't bottom here bottomed there. So we know that's a strong bottom, and that puts more evidence in place that October of last year was the bottom of the stock market. Now here's the thing, if we could just go back to XLK, there's a lot of movement, like there's a lot that XLK could fall, right? If that's the top to bottom, it's about 45% up, and to the bottom it's about 33% down. So we could definitely have some volatility in here. What we're really looking for is to make sure that XLK really stays, if you want a number. I'm looking at XLK on stock charts, which includes dividends reinvested, and that price is at about 160. So that's where you really would want technology to stay above. Okay, so let's wrap this up and let's talk about what this means, what to do about it, and how this creates stability and sustainability and ease for just staying into retirement and not worrying about the market. So this is what we know. Utilities have not gone anywhere for 18 months. Actually, since the pre-COVID high, they have not gone anywhere. And in many ways that makes sense, because as soon as the stock market started falling out of bed, it was because the economy got turned off and then immediately got turned on with 4 trillion, 8 trillion, trillions of dollars of stimulus, of money printing. And so the market went crazy high. Okay, but we're 18 months past the high of the market. And right now the XLK, or technology to utilities ratio, is at that high again, along with almost everything else. So this is not new if you've been watching this. But this is important because if you're retired and you want to stay retired, you don't have to look at this. But if you want to know if more stability is coming in or more instability is coming, this is a ratio that you could look at to understand more about what's happening. And we do also know, I'll throw this in as we are wrapping up, that the Fed in the next 20-ish days, their next meeting, I believe, is July 26th. So from the recording of this, what's that, about 19 days from now? Looks like they will increase the federal funds rate another 25 basis points, or another 0.25%. So that's going to put their upper range at 5.5%. And so it's going to be interesting, and I believe the market already knows this, is how tech is going to react to now an interest rate or a federal funds rate of 5.5%. Let me know where you think I got it right, where you think I got it wrong. Subscribe, leave a comment, or give a thumbs up. All those things help. I was going to say all those things happen. Of course they happen. All those things help with the algorithm. And if you have curiosity what your own portfolio would look like without something called replication, it's something we see over and over in retirement accounts, and it is very expensive to have replication in your portfolio. If you want to see how replication is hurting you, then go to the link below and you can get on our calendar, and we look at your numbers in your portfolio and we tell you the exact number of how much your portfolio is leaking without changing any risk or volatility, just eliminating replication, how that can really change your life. Thanks so much. I appreciate you being in my world and watching my video this week. Take care, and I'll talk to you soon.